Hello and welcome to the lecture for Chapter 2. Chapter 2 concerns accruals and deferrals, which are ways of recording transactions that help us tell a more true story about what happened in a business. So I'll talk about receivables, that's money that people owe us. I'll talk about payables, money that we owe other people. I'll show you some financial statements that use accruals. And I'll talk about the steps in the accounting cycle, kind of what we do first, second, third, and so forth. I'll talk about some types of deferrals. So that means pushing something out into the future, recognizing it later. That includes supplies, prepaid items, and unearned revenues. And then I'll show you financial statements that contain those types of elements. So accrual accounting, you may have heard that term before. What it really means is in contrast to cash accounting. So cash accounting would be recognizing revenue when I get paid by somebody and recognizing expenses when I actually write the check and pay for them. The reason that that's generally not considered correct is it's too easy to manipulate, and it doesn't really tell the truth of what happened in a particular period if I can wait until January to pay a December bill and not recognize that expense in the first year. So in accrual accounting, the important thing there are the things I've underlined on this slide. We recognize revenue when we provide the service or product to the customer, regardless of when we get paid later. And we recognize expenses when we incur them, meaning when we then owe the money, not when we make the payment later. So accrual accounting is required by generally accepted accounting principles, or GAAP. It's one of the things that allows us to compare financial statements of different companies and make a meaningful comparison, and then also make a meaningful comparison of a company's financial statements over time, consistency. Very, very small companies can use cash-based accounting, but most of the companies that you will work for use accrual accounting. So one way to think about accruals and deferrals, those are words you probably don't use very often. So accrual is something that we want to add to our accounting records in a particular period. That's when an action happens now, but the cash is going to happen later. Maybe I did work for you in December, but I'm not going to get paid until January. I want to add that to my books. I want to record that this year. Maybe you're an employee and you do work for me, and I'm not going to pay you until January 2nd. So you do the work for me in this year, I'm going to pay you at the beginning of next year. Well, I'm not writing a paycheck, so I'm not generating a transaction in my transaction grid, but I need to add that to properly state what happened. I incurred expenses and I owe some money. That needs to be in my accounting records. Deferral is the opposite. It's when cash happens now, but the action is going to happen later. Maybe I buy some supplies now, but I'm going to use those supplies later in an effort to earn some revenue. So I don't want to record the expense now. I want to record it later when I actually use it, not now when I paid for it. And again, that helps me tell a more true story about what happened in a company. So accounts receivable is the amount of cash the company expects to collect in the future from its customers. And here we can see on a transaction grid, that first transaction is when we provide products or services to a customer. So when we do that, in this case, we provided $84,000 worth of services. Accounts receivable goes up because after the transaction, more people owe us money. That's accounts receivable. Retained earnings goes up because we're recognizing $84,000 in net income or in revenue. When cash is received later, that's going to be an asset exchange transaction. Cash is going to go up and accounts receivable is going to go down. After I receive that cash, I have more money in the bank and less people owe me money. So that's kind of how we account for accounts receivable. We'll get into accounts receivable more in one of the later chapters. Accounts payable is the money that we're going to have to pay in the future. If accounts receivable is money we're going to receive in the future, accounts payable, money we're going to pay in the future. So that's what happens when we buy things from people or and going to pay them later, or when people work for us and they're going to get paid later. That's what's showing here is instead of accounts payable, we have other categories like salary payable, income tax payable, all of that. In this case, salary payable, we want to increase that liability and recognize the expense, because people have worked for us, but we haven't paid them yet. Payday hasn't happened. So salaries payable increases, retained earnings goes down. This is a claims made exchange, or claims exchange transaction. We recognize that retained earnings is going down because we're recognizing an expense. Later, when I pay that, cash is going to go down and my liability is going to go down because I no longer owe that money. So when the cash is paid, that's an asset use transaction. Cash goes down, salaries payable goes down. So here's an example of a transaction grid for a company that is experiencing these kinds of transactions. You'll see number 2 and 3 of the example of providing consulting for somebody and recognizing the revenue and getting paid for part of it later. Transaction 6 is recording the salary expense at the end of the year that I haven't paid for yet. So here is an example of those transactions amongst other transactions like we learned in chapter 1. So the way financial statements look for that, again, you'll see here consulting revenue, we're recognizing 84,000, not the 60 we got paid, but the 84 that the services we provided. And we're recognizing the expenses, which include the $6,000 of salary expense that we haven't paid yet, but we have incurred it. And that net income figure of 66,000 flows down onto our statement of changes in stockholders' equity. And on our balance sheet here, now we have a new asset, accounts receivable. We have a liability, salaries payable that we haven't seen before. Those are reflected on our balance sheet. So the accounting cycle works like this. We record transactions as they occur within the business. At the end of an accounting period, usually a month, we'll make some adjustments. So things like recording payroll that we haven't paid yet, but people have worked for us. That would be an example of an adjustment that we would want to make to the books to more accurately describe what exactly happened. Once we've made those adjustments, we'll prepare our financial statements. So we'll prepare formal documents that tell people this is how the business is doing and this is the health of the business. At the end of a year, we'll close the temporary accounts, which are accounts that we want to kind of reset each year. As an example, if I buy a truck, well, I still have that truck next year. I don't want to close that out. But if I'm looking at rent, say I pay $1,000 a month for rent, well, I want to know both what the month amount is and what the year-to-date amount is. Well, when I come to December, I want to reset that at the end of December, so my year-to-date in January reflects just the 1 month. So once we close the temporary accounts at the end of the year, then we start recording transactions again in the new year. So next, some examples of deferrals. And again, that's where the action happened, or the cash happens now and the action is going to happen later. So one example of that is supplies, and it's an easy one to conceptualize. Let's think of an example where we are providing janitorial services to the university and we buy a whole pallet full of cleaning spray, like 409 or something. And we get a really good deal by buying a whole pallet of that in January, and we pay $1,000 for it. Well, that's a cost we incurred. Well, is it an expense? Well, no, it isn't, because we haven't used it yet. It's something we own. We could turn around and sell our unused cleaning spray if we wanted to. So we record that as an asset called supplies. It becomes an expense as we use it up. So at the end of every month, we would look at that pallet and count how many are left to figure out how much has been used and record that as an expense, because the consumption of that supply is an expense we incur in an effort to earn revenue, or what we charge the school for cleaning. So once we purchase it, it's an asset. Once we use it, it becomes an expense. So here's an example. We purchase supplies for $5,000 in cash. That's an asset exchange transaction. Cash goes down, supplies goes up. At the end of the month, we count our supplies and we determine that 3,000 have been used. So we see we still have 2,000 left. So we record an adjustment. We reduce supplies by the 3,000 and we record an expense, which pulls down retained earnings of 3,000. A similar example are prepaid expenses. And rather than being tied to physical depletion sort of measurements, these really happen over time. And an example might be insurance. Those of you that own a car that pay for car insurance know that you pay in advance for your car insurance. So you pay at the beginning of the year, and that covers you for the upcoming year or 6 months, whichever you choose. And so in that case, we own something. We own prepaid insurance, and it's going to become an expense as time goes by. Rent is another example of that. So the way this works here, on April 1st in this example, we pay cash of $12,000 for a 12-month insurance policy. So when we record that transaction, cash is decreasing, prepaid insurance and asset is increasing. At year end, the insurance expense of $9,000 is recognized. Well, how did I determine that? Well, $12,000 divided by 12 months is $1,000 per month. And from April 1st through December 31st, 9 months have gone by. So I reduce my asset by $9,000 and recognize $9,000 of expense, which pulls down retained earnings. Again, this could have been prepaid rent, or I've worked in companies where we've had prepaid advertising, all of those sorts of things. The next category is is revenues that we receive the money in advance. If the prior two categories I mentioned were where we paid money in advance for expenses, here we're receiving money in advance of actually doing the work. And this was a little bit tricky. So when we receive cash in advance, we are going to increase cash and we're going to create a liability called unearned revenue. The reason for that is if we don't provide those services, we owe that customer back that money. Often use an example of season tickets for the Seahawks. Say you spend $1,000 to get a seat for the Seahawks. Well, they're going to play 10 home games, and that's how they earn that money from you. If for some reason, so you pay them in June or July your $1,000 to get your 10 tickets, well, if the season is canceled because of COVID or who knows what, they owe you that $1,000 back because they haven't performed the games. They haven't earned the money yet. As they earn it throughout the season, that's going to reduce that liability. So as an example here, we receive an advance payment on November 1st of $6,000 for consulting services. So cash goes up, that new liability, unearned revenue, goes up. So both sides of the equation go up. At year end, we look at our records and see that $4,000 of the $6,000 have been provided. So we reduce that liability. If we quit today, we would not have to pay them back as much money. So we reduce that liability, and that's when we recognize revenue, because now we've actually performed the services, and that's when we get credit, in a way, for the revenue. So here's an example of some further transactions, and you can see now we've got some adjustments that are being made relative to the transactions. So the first one there the first adjustment relates to transaction 2, where we paid to purchase supplies. We do a physical count, see we've got 150 left, so it means we consume 650. The next one deals with rent expense. So on the third transaction on March 1st, we paid $12,000 cash to lease office space for the year. So again, that was prepaid rent. So at the end of the year, we would recognize how many months have passed and how much rent needs to be recorded as an expense and reduce that prepaid. Transaction 3 deals with unearned revenue. In this case here, we received transaction 4, $18,000 cash in advance from a company for installation services. So here we'd recognize how much of that has been earned. And then the last transaction, we recognize that we have some accrued salary expense, which means people have done work for us. We need to recognize an expense and we owe them money. That's an accrual. So another way to record these transactions is like this. This is essentially the same as a transaction grid. It's just in a different format, and this is closer to what you might see in a company. So for each category, we've got the details of the transactions. Notice the number in parentheses there. So the first transaction, number 1, cash goes up by $55,000. we can go over to common stock and see the other number one where common stock is increasing by 55,000. So in this way, that number in the parentheses is kind of our way to trace what is shown here back to the transactions that were listed on the previous slide. So that will produce an income statement like you see here. So now it's getting a little bit more complicated. We've got multiple types of revenue, multiple types of expenses. And again, some of these expenses are as a result of those adjusting entries we made. So the rent expense and supply expense came from those adjustments we recorded. The net income of $54,250 flows down into the statement of changes to stockholders' equity. And then on our balance sheet, we've got a couple of things here that we haven't seen before. Accounts receivable, supplies, and prepaid rent are assets we haven't seen before. And under liabilities, we've got accounts payable and unearned revenue, which we haven't seen before, and salaries payable as well. So that is the last slide for Chapter 2. Thank you for your attention. I look forward to speaking to you when we cover the next chapter. Thank you.